Each tick represents $1 trillion. 600 ticks. That's how big the most dangerous market in human history has become. A market no one sees, no one understands, and yet it sits beneath everything. Your savings account, your mortgage, your pension, your nation's debt. It's called the derivatives market, a market so vast it dwarfs the real economy 6 times over. Worth $600 trillion on paper, but made entirely of promises, leverage, and illusion. Warren Buffett saw it coming 2 decades ago. He called derivatives financial weapons of mass destruction. Back then, the bomb was small enough to defuse. In 2008, it exploded and nearly vaporized the global economy. Lehman Brothers fell. AIG collapsed. Governments printed and borrowed $29 trillion to stop the chain reaction. But instead of dismantling the weapon, the world rebuilt it. Bigger, faster, deadlier. Today, that same system has grown tenfold. The numbers are so enormous they barely make sense. JP Morgan Chase alone holds $54 trillion in derivative exposure, more than 10 times the size of the entire U.S. economy in 1980. 4 banks, JP Morgan, Citibank Bank of America, and Goldman Sachs, together control $186 trillion in financial bets. One misstep in their digital labyrinth, and the chain reaction begins again. Only this time, there's no one left to save it. Because the real danger of derivatives isn't what you see, it's what you can't. They link every institution on earth in invisible threads of debt and speculation. When one breaks, all strain. When several snap, the web collapses. So ask yourself, if 2008 was the warning shot, what happens when the full weapon detonates? Pause sound of ticking intensifies. Tick. $1 trillion. Tick. $2 trillion. Tick. $600 trillion. And somewhere inside that number lies the one trade, the one bet that will unravel everything. When this bomb explodes, the narrator whispers, it won't just take down banks. It will take down the illusion that money was ever real. Before there was a $600 trillion time bomb, there was an idea simple, elegant, and deadly. It began with a promise: we can make risk disappear. In the 1980s, Wall Street discovered something extraordinary. If you could turn risk into a tradable product, you could make infinite money. Farmers had always used futures to protect their harvests, selling wheat in advance to lock in a fair price. Airlines hedged against fuel spikes. Businesses managed currency swings. These were tools of stability, the humble beginnings of derivatives. But in the skyscrapers of Manhattan, ambition mutated into something else. Bankers realized they didn't need to own the wheat or the fuel or the currency. They could simply bet on their prices. And if one bet could make $1 million, then 1,000 bets could make $1 billion. By the 1990s, derivatives had escaped the farm and conquered finance. They were no longer about hedging risk. They were about manufacturing profit. Wall Street's best minds, physicists, mathematicians, computer scientists were hired to design contracts that could turn uncertainty into wealth. These were the quants, the modern-day alchemists, transforming financial lead into gold. Every new invention birthed another layer of complexity. Futures became options. Options became swaps, evolved into credit default swaps, insurance policies on debt that might never default. The market grew faster than regulators could comprehend. Then came 2000 and the law that changed everything, the Commodity Futures Modernization Act. It legalized the unregulated trade of over-the-counter derivatives, trillions of dollars in private contracts between banks unseen by the public, untouchable by oversight. In the words of then Federal Reserve Chair Alan Greenspan, the market can regulate itself. Those words lit the fuse. Within a decade, banks were no longer institutions of savings, they were casinos. Every mortgage, every loan, every bond became a chip on the table. By the early 2000s, global derivative exposure exceeded $60 trillion, a shadow financial system large enough to swallow nations whole. And yet, the machine kept accelerating, leverage on leverage, bet on bet, until one day in 2008, the system met its first real test, and the world discovered what happens when a mathematical fantasy collides with human greed. The story of 2008 didn't begin with Wall Street. It began on quiet streets in ordinary homes. Families were offered mortgages they couldn't afford. Banks bundled those loans into exotic financial products called mortgage-backed securities. They were rated AAA safe as government bonds, but the safety was an illusion because buried inside those bundles were millions of bad loans ticking quietly beneath the global economy. Wall Street didn't stop there. They took those securities and built derivatives on top of them, bets on whether those loans would fail. Each layer amplified profit and risk. A financial skyscraper built on sand. When housing prices started to fall, the foundation cracked, and at the top of that tower sat Lehman Brothers. On paper, Lehman appeared strong $639 billion in assets, $613 billion in liabilities. But hidden in footnotes was the real danger, $35 trillion in derivative exposure. These weren't assets Lehman owned. They were bets Lehman had made with counterparties across the planet. When the bets went bad, nobody knew who owed what or who would survive. On September 15, 2008, Lehman filed for bankruptcy. In an instant, the financial web snapped. Every major bank had contracts with Lehman. When Lehman died, its promises died with it. Banks stopped trusting each other. Credit froze. Commerce halted. For the first time in modern history, the world's financial system stopped moving. Then came the second explosion, AIG. The insurance giant had sold $500 billion worth of credit default swaps insurance on bonds and mortgages it didn't own. It collected premiums, but never kept enough cash to cover a collapse. When housing prices plunged, AIG owed tens of billions it didn't have. September 2008, the U.S. government intervened. An emergency $85 billion loan became $180 billion in weeks, the largest bailout in history. But the money didn't really go to AIG. It went through AIG to the banks that had placed the bets. Goldman Sachs received $12.9 billion. Merrill Lynch, $6.8 billion. Deutsche Bank, billions more. AIG's bailout was the lifeline of the global casino. The total cost of saving the system reached $29 trillion worldwide, nearly double the U.S. economy. Central banks printed money, governments guaranteed debts, and taxpayers carried the burden. But the lesson wasn't learned. The system was saved, and the weapon reloaded. Instead of dismantling the machine, policymakers allowed it to grow. Derivatives weren't banned, they were institutionalized. More complex, more opaque, more global. 2008 was the warning. A tremor before the quake. And as the dust settled, a chilling realization spread across the financial world. If $60 trillion could almost destroy civilization, what happens when it becomes $600 trillion? It's the year 2025. 17 years after the last great collapse, the weapon that nearly destroyed the world has evolved into a financial superorganism, vast, invisible, and unstoppable. The global derivatives market now stands at over $600 trillion in notional value. To put that in perspective, the combined GDP of every nation on Earth is around $100 trillion. That means the derivatives market is 6 times larger than the entire real economy, a financial shadow towering over civilization itself. But what exactly makes up this monster? Over $500 trillion of it is tied to interest rate derivatives, bets on whether rates go up, down, or stay still. In the calm years of low inflation, these contracts seemed harmless, even useful. Banks hedged their exposure. Pension funds protected their portfolios. But when central banks began raising rates in 2022 at the fastest pace in 40 years, that calm turned into chaos. Every rate change created winners and losers. The losses hidden behind accounting tricks and opaque books are now silently accumulating inside the system. Then there are credit derivatives, about $50 trillion in total. These include credit default swaps, the same instruments that blew up AIG in 2008. Back then, the problem was bad mortgages. Now it's corporate debt. Companies borrowed trillions during the era of zero interest rates. Today, they must refinance at double or triple the cost. When those debts default, the credit derivatives ignite. Next come currency derivatives totaling around $100 trillion. They are bets on the stability of global exchange rates, especially the US dollar. But for the first time in 80 years, the dollar's dominance is being challenged. China, Russia, India, and Saudi Arabia are trading in their own currencies. If the dollar weakens significantly, trillions in currency derivatives will move violently, and some of the world's largest banks will be on the wrong side of those trades. And that's just the surface, because behind those numbers is something more dangerous: concentration. 4 banks, JP Morgan Chase, Citibank, Bank of America, and Goldman Sachs, now control over $186 trillion of derivative exposure. That's nearly twice the size of the global economy held in the hands of 4 institutions. JP Morgan alone holds $54 trillion in derivatives, with assets of just $3.7 trillion and equity of $300 billion. That's 180 times leverage. Every dollar of real capital supports $180 of bets. Citibank, $48 trillion. Bank of America, $37 trillion. Goldman Sachs, $47 trillion. They claim the risk is hedged. They said the same in 2008. Their models assume everyone pays, what they owe markets stay liquid, and volatility stays contained. But the world no longer fits those assumptions. Because these aren't separate institutions anymore, they are a single web. Each bank hedges with the other, locking them into a closed loop of dependency. When one fails, they all fall. The difference between 2008 and now isn't complexity, it's scale. Back then, one bank's fall nearly ended the world. Today, 4 banks are the world. And when the first domino falls, there will be no circuit breaker strong enough to stop the chain. Every crisis begins with a trigger, not one event, but a spark that hits dry tinder and sets the entire structure ablaze. In a $600 trillion system built on leverage, the spark can come from anywhere, and right now the fuses are already burning. Trigger 1. Interest rate volatility. Over $500 trillion in derivatives depend on the direction of global interest rates. For over a decade, rates were near zero. Banks became addicted to stability. They took massive positions assuming nothing would change. Then between 2021 and 2023, the Federal Reserve hiked rates from 0% to over 5%, the fastest increase in 40 years. Those shifts didn't just hurt borrowers, they shocked the derivatives market. Each rate change caused a wave of margin calls, demands for collateral that drained liquidity from the system. Banks that appeared solvent on paper are now quietly sitting on billions in unrealized losses hidden by accounting loopholes. As rates swing, those losses grow and the cracks widen. So trigger 2. Commercial real estate implosion. Across the world, office towers stand half empty. More than $2 trillion in commercial mortgages must be refinanced by 2026 at triple the original interest rates. Many will default. When that happens, the credit derivatives linked to these loans, especially CMBS swaps, will detonate. The first defaults won't end the system, but they'll expose the weakness hiding beneath regional banks, pension funds, and insurers. One regional collapse could ripple into the global web through derivative exposure, just like the subprime shock did in 2008. Trigger 3. European banking fragility. Europe is once again on the edge. Credit Suisse already fell in 2023, absorbed by UBS. Deutsche Bank, with $40 trillion in derivative exposure, remains one of the most fragile pillars in the global system. If a major European bank falters US, banks will bleed within hours, connected through thousands of swap contracts. In this system, a bankruptcy in Frankfurt becomes a liquidity crisis in New York overnight. Trigger 4. Sovereign debt and the East Japan, the world's most indebted nation, carries government debt worth 260% of its GDP. For decades, it survived by keeping interest rates near zero, but inflation is now forcing the Bank of Japan to tighten. Even a small rate hike could cause bond prices to collapse, triggering trillions in derivative losses tied to Japanese debt. China faces a different storm. Its local governments and property giants, Evergrande Country Garden, have defaulted on hundreds of billions. Hidden derivative exposure to Chinese debt could pull Western banks into the chaos. The trigger could be interest rates, real estate Europe, or Asia. But it doesn't matter where it starts, because once the first domino falls, the rest follow. And in a world wired by $600 trillion in promises, that chain reaction would move faster than any government could respond. In 2008, governments and central banks around the world came together to stop total collapse. They unleashed $29 trillion in bailouts, guarantees, and money printing. That was nearly 40% of global GDP at the time. It was enough to save the patient, but not to cure the disease. 15 years later, the tumor has grown beyond any surgeon's reach. The world's derivatives market is $600 trillion, 10 times the scale of the crisis that nearly destroyed civilization. If even 10% of that goes bad, the losses would equal $60 trillion more than half of total global GDP. There isn't enough capital, liquidity, or political will on Earth to contain that explosion. Let's start with the numbers. The United States is already drowning in $36 trillion of national debt. Japan sits above 260% of GDP. Europe faces record deficits. China's local governments carry trillions in hidden obligations. There's no balance sheet left strong enough to absorb another global bailout. In theory, central banks could print the money as they did during COVID and the post-2008 era, but the results are already known inflation. Between 2021 and 2023, the Federal Reserve's balance sheet ballooned to nearly $9 trillion, igniting the worst inflation in 40 years. Now imagine printing another $20 trillion to rescue derivatives markets. The currency itself would break. The dollar, the foundation of the global financial system, would erode under the weight of its own rescue. Printing money saves banks, but it destroys trust, and trust is the currency that underpins every other. And then there's the political wall. In 2008, the public still believed their governments when they said the banks had to be saved. People were angry but compliant. Today, that compliance is gone. 15 years of stagnant wages, record inequality, and skyrocketing housing prices have destroyed faith in institutions. The phrase "too big to fail" has become too big to forgive. If a new bailout were announced, now trillions for Wall Street, while ordinary citizens lose homes, jobs, and savings, the backlash would be explosive. Governments know it. That's why they'll hesitate. And hesitation in a derivatives crisis is fatal. Even if the will existed, the mechanics wouldn't, because derivatives aren't assets. They're contracts between parties. When one side loses, the other side wins. Bailing out the loser means rewarding the gambler. There's nothing tangible to buy no mortgage, to seize no property, to stabilize. Just promises built on promises. In 2008, the government could buy bad mortgages and hold them until recovery, but you can't buy a swap or own a hedge. You can't stabilize an abstract bet. You can only pay it with money you don't have. You can't bail out a system you can't even understand. That's the silent truth at the heart of the next collapse. The weapon has grown too powerful, the rescuers too weak. And this time, when the bomb goes off, there will be no one left to pull the fuse. It begins quietly. One bank, just one, misses a margin call on a derivatives contract. The number seems small at first, a few $billion, but that single missed payment sets off the chain reaction. Counterparties panic. Clearinghouses suspend trades. Markets freeze. By nightfall, it isn't just one bank. It's dozens. Every financial institution on Earth is connected through a web of contracts worth $600 trillion. When one node fails, it pulls the next down with it faster than any human can react. Within 48 hours, the derivatives network that underpins global finance unravels. ATMs begin to limit withdrawals. Banks quietly lock digital transfers. Credit card systems lag, then fail entirely. By the third day, pension funds announce temporary valuation adjustments, a euphemism for collapse. The digital economy, the heartbeat of civilization, stops. Governments respond in chaos. The Federal Reserve, European Central Bank, Bank of Japan, and People's Bank of China hold emergency calls. They announce unlimited liquidity, temporary support measures, and coordinated stabilization programs, but the markets don't listen, because this time the losses exceed the system. You can't print $60 trillion overnight. You can't create confidence when faith itself is gone. The money being lost isn't real. It's leverage, evaporating faster than it can be replaced. Global trade halts. Cargo ships remain anchored, waiting for cleared payments that never arrive. Oil stops flowing. Factories go dark. And within weeks, the shock ripples from the financial world into the real one. Unemployment spikes. Governments impose capital controls. Some nations close their borders to protect their currencies. Others default entirely. The illusion of control vanishes. People who once trusted the system begin to realize the system was trust. The real economy was always fragile, dependent on confidence, on invisible code, on a shared belief that money meant something tangible. Now that belief is gone. This isn't the end of money, the narrator says softly. It's the end of illusion. For decades, humanity built towers of speculation higher than any cathedral, but those towers were never made of stone, only paper numbers and promises. When the tide recedes, only the real things remain: land, food, water, energy, and trust. The financial empire will fall, but life will continue. Those who understand reality will rebuild on what's real. And as the echo of the collapse fades, one truth will remain carved in history. Every empire ends when its debts can no longer be believed.